Let's get to the advisory and take a deep dive into property. What are some of the key considerations when selecting where and what you should invest in? Dominic Cavagnino from Binnari Property joining me now. Dominic, good to see you. I mean, for a lot of people, it's about affordability, but what are you seeing?
Yeah, look, it's been really interesting. I mean, our business was set up to help investors make better decisions when it comes to investing in property. And some of the key things that we look at are a lot of those economic trends that you've sort of been discussing and what is going on around the country and the world and how that impacts the markets. But we really try to simplify it for our clients and just talk about things like that. We can really analyze the current market cycles. We're very lucky that in Australia, every property market or capital city or region seems to be at a different point within its property cycle at any given point in time. So we're trying to analyze, what is happening in those markets, what has typically driven those markets, and where are those sort of factors at the moment to determine whether or not there's an opportunity for investors to take advantage of. And then it's really important to actually kind of consider, what is the right type of property to purchase when you do establish the right market, and understanding what is in demand from locals, and making sure that as an investor you do make strong decisions around what you are purchasing up front, because it can have a really major impact on how well the property pans out for you over time, and how well it achieves the objectives you set out to achieve. So there are a number of key considerations. Some of them are market cycles, some of them are population growth, economic drivers, employment diversity, supply and demand is a crucial one, and then even zoning into the more sort of simplified things like, how do you think like a local and buy properties that appeal to people who are living in and working in those areas, and that are going to be attractive from both a rental and a sort of resale perspective. So those are some of the sort of key considerations that we're consistently looking at and monitoring, and then sort of feeding that information back to our clients to help make sure that they're making the right decisions when it comes to investing in property.
Dominic, the biggest thing though is this is most people's, I should say, biggest purchase they're ever going to make. It's also highly emotive because it's where you live. What are some of the mistakes and what do you advise people against doing?
Yeah, look, one of the traditional mistakes we've found, and when you're buying to live in, it's a little bit different because, as you say, it is very emotive, and it is, something that everyone has different preferences when it comes to where they want to live. I think when it comes to investing, though, it is a little bit easier to fall into the traps of making mistakes that a lot of people have done. One of the very typical ones I see is, investors buying in heavily saturated areas where, yes, price points may be slightly more affordable, but the level of supply will really dilute the potential growth that is achievable to them. So that's one of the key issues. And the other one is, when you buy as an investment property, you're often told to take the emotion out of it because it is more of a financial and business-based decision. But applying some level of emotion to the decision is also important, because the property you're purchasing, you do need to make sure that someone will want to live in that, making sure that the property has ample natural light, making sure that the floor plan is functional and livable for the type of family or household that is going to occupy that property. I find that the most of the time when people have made mistakes, they're investing in properties that, are very compromised and are really only of appeal to potentially an investor. No real owner occupier would sort of consider it a place that they would like to live in. So that's one. And then the other one is a tricky one where it tends to be people buying in sort of one-dimensional towns or cities, where there isn't that diversity, and the disappearance of one or two key factors really has a detrimental impact to the property you've purchased. So I think the ways to avoid some of those typical mistakes is buy in areas where there's a very diverse economy or very diverse employment opportunities, and buy properties that are going to appeal to the locals living in that area. And even if it is a property you never intend to live in, make sure that it has the attributes that would make that property desirable for those people who are living in that area. So that's something we sort of harp on about a lot to our clients.
Yeah, so really think like you're going to actually live in that property. Really good advice. What is the difference in terms of what's more important between cash flow and capital growth?
Yeah, Juliet, that one's a bit more of a personal kind of question, I suppose. It depends on people's individual strategies. As a business, our focus or preference has always been to probably focus on the capital growth side of things as being a bit more important. A lot of our clients are coming to us with, the objectives of building a portfolio, but the objectives of really increasing their wealth. And, there's no doubt that the potential that the property market has from a capital growth point of view can be, hugely beneficial to people in terms of growing their wealth. We've seen property in many of the capital cities double and triple over the last 10, 20 sort of years. So capital growth for us is probably our focus. But it is also important to complement that with a property that, from a cash flow point of view, you can afford to hold on to. Generally the most successful investors are buying with a very long-term kind of approach, or a long-term sort of strategy. So making sure that you can hold on to that property through having a reasonably strong cash flow is crucial. So it's probably, the correct answer is a bit of a blend of both, rather than sort of, completely neglecting one or the other. I think getting something that cash flows relatively well, property should cost some money to hold on to it. It shouldn't cost you anything. It shouldn't cost you nothing. But obviously making sure that that's manageable to then enable you to hold on to the property long enough to reap the rewards of the capital growth that's achieved over the long term. So it's probably a blend of both, which is important.